Well, thanks for tuning into this conversation on the earnings interaction with Federal Bank. Mr. Shyam Srinivasan joins in. Remember, in the business update that was anyways provided earlier, they had reported an overall stable performance with growth in business loans, deposits on a YY basis, on a QOQ basis as well. Interestingly, amongst the COVID-19 crisis, let's get him in to talk about how does he foresee the quarter gone by, the challenges thereof, and how the quarter ahead would be like. Mr. Srinivasan, good having you. Hope all is safe.
So far, all right. Thanks, Niraj. You take care. Thank you very much.
Thank you. Can we just talk a bit about the quarter gone by? For a lot of people who track the bank as well for the last so many years and quarters, seem to suggest that considering the challenges that we're on, you probably come out with the best quarter that you have had thus far. Can you talk a bit about it?
Sure. Thank you. And that's a good cue. I was going to say myself that this was our absolute all-time best quarter in terms of numbers. Our operating profit, as you would have noticed, crossed 1,000 crores, highest ever. Net interest income at 1380 crores, highest ever. As also the other income at 509 crores, highest ever. So I think on the back of all these things, the bank's overall performance driven by strong liability growth, credit growth in chosen areas has been very good. And this mix has helped us create a strong operating profit, giving us a good room for growing our, creating a higher provision against any possible issues that may come up in passage of time as the impact of COVID plays out. So we've had a very strong quarter on operating performance metrics, and we made meaningful provisions too.
Yes, and I can see parts of that, but just actually first a couple of highlights as well. When I look at the loan advances, when I look at the CASA numbers, all of those seem to have improved. Would you reckon this is an industry-wide phenomenon, or have you been able to do slightly better? Because I think compared to the averages as well, you seem to have done better.
Yeah, I think if you see our RBI's supplement, weekly supplement, we've consistently been gaining share. So yes, the average, the top tier banks have gained share on liabilities, and we belong to that cadre. Not only just now, if you see many quarters, the biggest strength of our bank is our liability franchise and retail. We are 90% plus retail liabilities. So we don't have purchased bulk deposits, and that's a big strength. And in times of stress as now or during the demonetization, we've always seen a gain in deposits for the bank. And every time there is some kind of a unrest in any of the Middle East markets, we gain share. So our liability gain has been consistent. And credit this quarter, the last 2-3 quarters, we've been actively focusing on the higher margin gold loan business. So that has also given us good fillip the last 2-3 quarters.
For the second half, though, something that you mentioned, which is the provisions, and I think the common belief seems to be that higher provisioning, as well as maybe lower credit offtake because of the times that we are in, could impact the FY21 performance. FY21, anyways, the second half is full of maybe surprises for everybody. Would you reckon that that could well turn out to be true, that despite your other pluses that you have, the higher provisioning and maybe lower credit offtake might impact the near-term performance?
See, I think, Niraj, the first half credit growth and the second half credit growth, in normal times, second half is almost 60% of the year's credit growth. Let's assume that this year that's not entirely true, but at least 50% of the credit growth of the year will certainly be there because the festive season and hopefully there's a upturn in the sentiments. I don't think second half credit growth will be lower than first half. In fact, I think it may be slightly better. You saw that we gained share in H1. There's no reason why we should not gain share in H2. And our incremental focus on businesses that are higher margins like gold loan, business banking, commercial banking are all playing through very well. And our momentum on that is quite strong. Even the 15 days of October have been very good. So I do believe growth on that dimension should not be a challenge. The wild card for all of us is how does the credit quality and customer repayments shape up to prevent or to hedge ourselves against any kind of extreme situation is why we made this significantly higher provisions in standard assets. And that's why you saw about 400 crores of standard asset provision we've created. just by way of average, that is almost 12% of our gross NPA. So if you add that, my coverage ratio just shoots through.
Okay. So that is things inherent to Federal Bank. Now there are a couple of how do I say judicial / sovereigns / the head of the banking department led decisions that are slated to come out. Can you talk about, Mr. Srinivasan, for your bank as well as for the industry? What do you think the nature of the impact could be? It's a binary event of sorts, so either case.
No, I think if you're talking to the interest on interest matter, then we've taken all 2 crore and below accounts where interest on interest may get waived, and we dimensioned it. It's only about 10 crores for us. We made a provision this quarter, so we, one way or the other, we are protected. At an industry level, that number is touted around as anything between 4 to 6,000 crores. Some say even higher, but let's assume that 5,000, 6,000 crores. In the wider scheme of things, I do believe the government, from all indications, looks like they will share and support the banks on that count. So I don't believe we will have very material issue on that count. The bigger issue, I keep coming back, the regulatory uncertainty is more or less, the legal uncertainty is more or less over. I think the issue is customers' capability to ensure either they take restructure and honor commitments, or don't even take restructure and honor their commitments. I think that's the one that one has to watch out for. And you'd see different banks making their best estimate and start making provisions for it in Q2. Some may have made it in Q1. Some will start dealing with it in Q2 and Q3. And as you see, in our case, we've made meaningful provisions in Q2 in particular to deal with what may be potentially the challenge that will come through in Q3, Q4.
Would you therefore reckon, Mr. Srinivasan, that the chances of a large negative surprise, at least from your end, in either Q3 or Q4, the chances of that are minimal? Sure, they could have, you might have to make certain other adjustments depending on which way the decision comes out and which way the sentiment improves. As I heard you say that the first 15 days are looking good, but who knows about the festive season. But the chances of a large negative surprise from your end, the chances of that are minimal.
The way I see it, or we see it, is slippages for Q3 and Q4 can be, the real issue would be how do the customers, whether they choose to qualify for restructuring or what they're going to do. And if they qualify for restructuring, we made the necessary provision. Now, let's say they don't qualify for restructuring and they don't honor their payment commitments, then if it is 2x our normal run rate, see, in a normal quarter, we have about 300 to 400 crore of slippages. We have to see how that shapes up in Q3, Q4. Now, instead of 300, 400, in my mind, it could be 50% off. Higher, it could be 450 to 500 crores is what I think it would be.
Okay. And I'm just drawing a leaf out of maybe the investor call that you guys did, and there were notes that came out post that. And I'm just wondering if your stance changes in any fashion whatsoever, because I think most people believe that between the GECL scheme, MSME restructuring, and the moratorium, the liquidity concerns for MSMEs have largely been addressed. And in your portfolio, about 50% of the MSMEs has anyways not availed of the GECL scheme too. So would you reckon that any stress on account of that for a large portion of your borrowers, any concerns of that are now largely behind you or largely factored in either case?
It does look like a reasonable part is addressed, but it presupposes nothing deteriorates from here.
Of course.
Right? If relative stability is there, then I think probably we have seen the worst part. Right? We've spoken to many of our customers directly, indirectly through various platforms, and we find that a large part of it has been captured either through potential slippages or through the restructuring that we've done, the restructuring provisioning that we've done. Sure. Okay. Last couple of questions, Mr. Srinivasan. From if
if you hear a market watcher or a market somebody is seeking advice on the markets, almost everybody seems to be asking one thing: why is there a dichotomy between the equity markets and the economy? My question to you is, because what you guys do is essentially be the first line of contact for economic growth, right? Because if people are borrowing more for business or otherwise, it will show that things are improving. Would you reckon, in your experience, based on the conversations that you have with your team as well as with some of your larger clients, are things looking on the mend, or is it difficult to say?
There is certainly more positive approach to the situation, but that's also largely by our own people wanting to be positive about the environment, right? So a certain degree of positivity reinforces positivity. But if you just look at volume flow, it has picked up to, I won't say 90 and all that stuff. I would say north of 75 to somewhere in the early 80s. That's the
Okay.
kind of run rate I'm seeing in most products.
You talk about pre-COVID compared to pre-COVID levels.
Yes. I'm talking of Jan Feb this calendar year.
Okay. And because my last question, because you would have looked at many cycles, does this pick up in momentum lead you to believe that we could be near normalcy soon, or again, because it is a very different world post-COVID,
I
it's
would
very
say
difficult to predict?
we must wait for January, because this could be a bounce because of seasonality and some kind of pent up. A real more effective picture would be only in January, and by that time, a lot of things will. So I would argue that Q3 also we must be a little more careful that you can't make too much judgment. But indications are it's a lot better than we had all visualized it.
Great. Okay. Mr. Srinivasan, great talking to you. Thank you so much. And most importantly, stay safe.
You too. Thank you so much, Niraj. Thank you so much. God
Thank
bless.
you.
Thanks.
Appreciate it. Bye-bye.
Thanks.
Viewers, thanks for tuning into this earnings conversation.